Hello, everybody. Welcome back. I'm Mike Smith with the Lowdown. Today, joining me is Robert Palmer, Avidian Wealth's head of financial planning. And Robert, I think today would be a good time to really talk about the big question out there is, well, let's just put it plainly. Is this a bubble and is it going to pop, right? That is kind of the big question we're getting. But, you know, we often are hearing, and we're hearing from a lot of people that, well, this is potentially like the dot-com bubble, or this is potentially like the housing bubble. But I think this is definitely something unique. It could be much bigger, but we could definitely dive into that. But to get your thoughts real quick.
Yeah, I think that's a great question. I know a lot of people are asking it. Every time I open up a web page, there's an article about the bubble. Is it going to burst? When's it going to burst? I think it's pretty clear, and there's consensus that we are in somewhat of a bubble right now.
Sure.
And you could tell that just from valuations alone, right? They've extended quite a bit to the point where people are like, we're a little overvalued. And, you know, as of today, we are seeing a pullback in the NASDAQ and in tech and in AI. So we're seeing people trying to figure out how to price it. And I also think there's a little bit of a self-fulfilling prophecy here when it comes to bubbles and bursts this time around, in that people are trying to time the market. And so the second they get a little bit of traction, like this thing might pop today, immediately you start seeing selling, and then algos kick in and they start selling. And next thing you know, you got like a little bit of a domino effect. But you brought up the fact that there's big differentials between what we're seeing today versus what happened in the past. And I'd like to talk a little bit about those differentials because I think they're important to understand when this thing might run its course or if it keeps going for a little while.
Sure.
A good example that always gets brought up in comparison to today is what was happening back in '99, right? The dot-com bubble. You had a ton of speculation, a ton of dot-com companies, and you had valuations blowing through the roof. Crazy stuff and a ton of speculation. What I would say is that a big differential between then and now is that we have profitability. We have strong earnings.
There's actual revenue.
Yeah, there's actual revenue. There's actual products. It's not just eyeballs. That's what was being priced in back in '99. It's how many people could you get to a website. Today, it's no, we have revenue. We have overhead. We got employees. We're actually running a full-fledged business. That makes it really difficult to say that they're one and the same. What are your thoughts? Because you
no, I think there's a lot of things. Well, one, and also today with the rolling up companies that are making revenue, that are expanding on this technology. And we're going to get into, I think, the big three drivers of what we're seeing. And we call today's market run, right? Or potential bubble. What's driving that? Well, number one, artificial intelligence. We're all using it. We've heard about it. It's replacing things that computers and humans used to do. It's making us a lot more efficient. And that's kind of the first stage. Then we're going to get into the scientific phase, which is robots and things working interrelated with us, and kind of what we vision scientific, but that's coming, right? I would say the next thing is into automation, which is the robotics. And then I think the last thing is going to be the space race, which is the fuel that's going to keep fueling all this. And we'll talk about the fuel demand because that's a big part of why this is happening. And if you were to just kind of think of a narrative, and when I talk about bubbles, I go back and I think the easiest narrative for people trying to understand is imagine the bubble is fueled by liquidity, right?
Yes.
And so think of liquidity, as Bruce Lee famously says, think of water, my friend, right? So just think of this water, is sitting in a pool, and a new bubble would be a river that's being dug. And right now, the three things that are digging that river are digging within no end in sight. So that water's rushing up the river. And when it ultimately stops, what happens? Water rushes back, and it ultimately settles in the mean. But we don't know when that water is going to stop rushing.
Yeah, that's a pretty good analogy. And I also think, just going back to the differentiations, I think the reason why people are so concerned today is they're worried about those valuations. How far has that water gone down that channel?
Yeah.
You know, have we reached the end? Is it going to start flowing back? Or is it self-fulfilling? If they see a little bit of water coming back, is everyone going to rush to, kind of like back in the early 1920s when we had the Great Depression and everyone was doing the run on the banks? You had something similar there. And I think the risks here go beyond valuation insofar as you look at things like margin debt.
Yes.
So it's really consumer debt today and valuations that pose the two biggest risks outside of geopolitical, which I don't want to go down that rabbit hole.
No, another show.
I'll just focus purely on financials. Consumer debt, particularly margin debt, is up to $1 trillion right now. So if you wind up having a really strong correction downward, it's going to create a domino effect where people are going to get margin called, and then you're going to start seeing the stocks pull back more and more and more. And the funny thing about that is that has nothing to do with the underlying business, right? So whether we're talking about like a Palantir in the AI space, or we're talking fintech or robotics or energy, that has nothing to do with those underlying businesses and how well they're performing. It has to do with how much leverage is being put into the stock market and how much can be absorbed in terms of losses before people have to start cutting those losses. And if you trigger that domino effect, you could see a pullback that is strictly financially created and not business related.
Well, let's talk about some of the vehicles. I mean, if you go back to the dot-coms, people were heavily margined. You look at the 2008, that was people were leveraging their homes, right? So that's where that excess liquidity. But today you're seeing things, and I can't believe it, but quadruple times ETFs of whatever index or technology indexes. So you got all these vehicles that are allowing for, and especially now the younger generation, they're coming in for fractions on the dollar to buy shares through Robinhood and some of these other vehicles.
Alts
so
in the 401k
this thing
now
is spread out, the alts in the 401k. So you can say that right now the liquidity channels are out there. And now I would say that hopefully we've learned some lessons from '08 is we have some of the stop gaps, some of the liquidity can be funneled into the market quickly to help avoid in a 2008 or a dot-com style like crash. So we hope.
Well, we have those famous last words on Wall Street, right? What are they? This time it's different.
This time
right?
I know, right? This time it's different. And you know what? Everything kind of rhymes very similar. But you know what? I mean, I would say every bubble, any market peak has its own unique stripes, right? It's got the similarities, but there's going to be some unique stripes to it.
Yeah, look, we're not seeing an '08 situation where there's mass fraud and ultimately
Correct.
a problem with the plumbing. There's not really a problem with the plumbing.
Yeah.
People may be overextended, and we may see some multiple contractions occur in terms of valuation. But that's really where the big risk is on the financial side, as far as I can tell. And I'm sure our CIO, Jake, would have other things to say as well. He's more versed on what's happening globally. I'm looking more domestically. But I think that's an important thing to keep an eye on, especially given where inflation has gone, the cost of goods, how much liquidity people can actually afford to keep in the stock market before they have to start pulling out to afford their lifestyle. There's a lot of consumer debt out there. Defaults are picking up a little bit, not a ton, but they are picking up. And that was actually one of the initial signs that Bill Burry picked up on, or Michael Burry, sorry, I said Bill Burry. Michael Burry picked up on in '08 when he was basically uncovering all the derivatives and the swaps and the CDOs, which also serve as leverage. So we're seeing levels of leverage now that are similar to prior bubble bursts. We're seeing consumer debt out there, and we're seeing a little bit of liquidity being a concern, but interest rates are also coming down at the same time.
Yes.
So this is a very difficult thing to read.
It is. Well, I would say I would throw one thing is sentiment. And so you were talking about the dot-com bubble. I remember being in Houston. I was downtown. I was, after work, and I'm listening to this guy. He's ordering a drink, and he's basically in his 40s. He had quit his job. Okay, and he's basically making money day trading. No kidding. Yep. And I also ran into people down there. We're in Enron, so kind of we know the Enron store here in Houston. But I always wonder, whatever happened to that guy? Because the market busted shortly after that, right? I'm hearing that today. I'm hearing people are quitting their jobs. They're day trading. They're making so much money as market. So the sentiment is getting very similar in what we've seen in the past. But how long this can run, I think, again, back to where it's fueled, can keep going for quite some time. That's the scary part about this.
Well, you have that other old Wall Street adage where when your taxi driver starts telling you to buy a stock, that's when it's time to sell.
Yes.
Or
back
today,
to Kennedy's,
the Uber driver. So I think that it is wise to start planning proactively for a potential downturn. And remember, we could be in 97 and not 99, right?
Exactly.
We could be a few years out before we see a serious crash. We could see corrections along the way, but we may be pretty far out because one of the things that this technological wave is bringing to us is efficiency.
Yes.
And it's not theoretical. It's present day efficiency. Like humans are saving time on tasks.
Yep.
They're automating out things that used to be extremely laborious.
Productivity is going through the roof.
Productivity is going up. And again, this circles back to earnings going up. So we could be in the early stages. The bubble could still have plenty of time to run. We don't want to say this time is different.
No, I know.
So one of the things I would say is, and this is relevant to a few friends of mine, is as you start seeing these profits really start ratcheting up, which they're already high even after today's correction, take a few chips off the table. Have some dry powder.
Yep.
Put yourself in a strong financial position. So if there is a big burst, you're able to buy in and then ride it back up, and then you're in a better position than when you started, even if you have to absorb some short-term unrealized losses in the market.
If you go back to some of the past bubbles, the ones that got hurt the most, their position, right? It became whatever it was, whether it was Enron, whatever .com, it became the outsized position that ultimately, when that bursted, it put them in a bad situation. Right. So to your point, you got to watch positioning, look at whatever sector, you got to dig down. And if you're getting ahead of your skis, you've made some money here. I think to your point, the only way to insulate yourself from whenever this is going to burst or pop, whatever we want to call it, is diversification and constantly gardening and pruning your position back.
100%. If you're using leverage to go into speculative assets, that is greed. So be very cautious when it comes to greed.
What happens? Pigs get slaughtered, right?
Pigs get slaughtered. So it's just pull back a little bit on the leverage, and you'd be surprised at how much better of a position financially you'll be in moving forward. We've been talking a lot of doom and gloom. I want to talk about silver lining, because there were winners out of the dot-com bubble burst.
Oh, for sure.
And if you held them, you may have suffered some slings and arrows, if you will, but you wind up making plenty of money along the way if you held them. So let's talk about some of the industries that I know you're very familiar with that you think might serve as good long-term investments. Well,
I think long-term, obviously anything AI, that's integrated everywhere. But my favorite right now is just looking at kind of this new space economy. If you think about what's fueling AI, GPUs, right? This is what's basically kind of the new oil of today. And we're behind in demand, and there's no single source of energy right now, in my opinion, that can make up the demand that's going to be needed. Today, I think we're seeing is about over half of searches are now done through some sort of AI program rather than Google searches. So the cost of that's like 8 times higher, right? Oof. So, and that's expected probably to be, most people are going to be using AI and no longer Google. I've heard some things like 70-80% usage versus today. So these are all, of course, speculative, but we can see the direction and how fast we're going there. So where are we going to get the energy from this, right? Well, we've got nuclear, which has basically come back, the new renaissance of nuclear. I'm happy to say Texas is the leading on that, but the United States is desperately trying to get power back on. But nuclear, in the form of small modular reactors, they're just in the beginning. They're just now in the phase, the race to the 4th of July for the first one to get any type of nuclear response or a reactor going. But when that technology gets implemented and scaled, that's years down the road. Yeah. So don't expect that to be the energy source today. And so when you look at space, you hear like solar-based, solar space energy, right? That's still in science fiction right now. That's a long time away. So fossil fuels, well, that's not going to do it. It's going to take pretty much everything. And then this massive race to the moon in space because of helium-3 and things that can support. And then, of course, there's technological advancements such as data centers in space, which I know a lot of companies that have recently just come out there, and a lot of private companies are going to do this. And because it makes it easier to store and have that. So all this is coming. And you think about the massive, think about the railways, into modern railways, but that today the railways are being building towards space, towards the moon. The moon is economically viable. Mars sets us distant. There's no economic viability. Becoming an interstellar species is great, but the moon and Jeff Bezos, where he's going, that's kind of the idea. We're expanding our economy. So back to the liquidity, you can see the river channel being dug. That brings value. It brings resources back. It drives down costs. It changed all of our lives. So it's a huge narrative that can be fueled for quite some time.
Yeah. So I'm hearing that, while there may be speculation today, a lot of these industries are going to be here to stay, and they're ultimately going to shape the future. And I think there's also some key things to look out for, like legislative risk. So for sure.
That's what always slows it down or gets in the way.
Exactly. So you have things like nuclear, for example, which seems like it's going to be a necessity.
Yes.
Just in terms of diversifying the fuel sources. And I think this also goes back to a good analogy that I was actually talking to a friend of mine here at Avidian with, which was, hey, look, this AI thing with all these chips and everything, it seems like a gold rush. But what I read about the gold rush is that the people that are actually making the money are the ones that were selling the shovels. They were the first millionaires during the gold rush, selling the equipment. So what are the shovels in this analogy?
Yeah.
And it seems to be energy.
Yes.
So if you find the right energy sector to kind of dive into, and you find the right company with the right mission statement, that ultimately could be your pathway to $1 million or be the first millionaire in this new gold rush with AI.
Well, and you're absolutely right. Kind of the players, if you think about it, is this big race between China and the United States. In the United States, I would say this is probably the first time you've seen this massive amount of innovation, this flood of innovators since Elon, SpaceX brought launch costs down. This massive wave of innovation for the space economy is there. And you're seeing for the first time private business, publicly traded, the big boys, and government all trying to partner to work towards a greater goal. Now, that gets derailed with things like, well, the government shutdown. Okay, so that gets derailed by things. Policy can get step in the way. But this becomes a bigger thing because there's also another opponent on the other side of the world that thinks much different than we do. And they're trying to get there first. And remember, he who controls the seas, he who controls space, controls the geopolitical narrative. Well, now today it's space and the next frontier, and the race is between us and China, and we have to continue we have to be ahead of this. It's just so, yeah. Well, tell me what you're finding funny.
Well, there's always a new frontier that needs to be conquered, and
yes.
I think the government's involved because of national security concerns.
For sure.
The public should be involved because that's where the new economy is going to be centered around.
Yeah.
Especially in the distant future, or maybe not too distant future, depending on how quickly we're able to scale. So I think that these are great silver linings in the face of today's bubble, great industries to be paying attention to. And again, make sure to manage the risk and make sure that you're diversify and make sure that you're in those companies that are going to succeed, not just 1 or 2 years out, but for the next decade in your lifetime.
Well, Robert, I think we'll end it there. I think this is all good advice. Maybe we'll do a part 2 in some of the past bubbles. We'll see how you like the show. Let us know. Thank you for joining.
Take care.